Hey there, investors! Are you ready to take your stock market game to the next level? Investing in stocks can be a great way to grow your wealth over time, but it's not without its risks. In this video, we'll be sharing the top 5 mistakes that novice investors often make when trading stocks, and how you can avoid them to maximize your returns. Stay tuned until the end for a bonus tip that could save you thousands of dollars in the long run. Investing in the stock market can be an exciting and rewarding way to build long-term wealth, but it's not always easy. Many novice investors make common mistakes that can lead to significant losses and missed opportunities. In this video, we'll be discussing the top 5 mistakes that we see new investors make when trading stocks and providing actionable tips for avoiding them. Whether you're just starting out or have been investing for a while, these tips can help you make more informed decisions and minimize your risk. Before we dive in, make sure to like this video and subscribe to our channel for more investing tips and strategies. We post new videos every week on topics like stock analysis, portfolio management, and market trends. Alright, let's get started. Mistake 1. Failing to do your research. One of the biggest mistakes that novice investors make is failing to do their research before buying a stock. It's easy to get caught up in the hype surrounding a particular company or industry, but it's important to take the time to thoroughly research any potential investment. To avoid this mistake, make sure to do your due diligence before investing in a stock. This means reading the company's financial statements, analyzing their business model and competitive landscape, and understanding the risks and potential rewards of the investment. There are many great resources available for researching stocks, including financial news websites, stock screeners, and analyst reports. Take advantage of these tools to make informed decisions about your investments. Mistake 2. Chasing hot stocks. Another common mistake that novice investors make is chasing after hot stocks that have recently experienced significant gains. While it can be tempting to jump on the bandwagon of a stock that's been performing well, this strategy can often lead to buying at the top of a market cycle. To avoid this mistake, focus on investing in companies with strong fundamentals and long-term growth potential, rather than chasing short-term gains. Remember that past performance is not necessarily indicative of future results, and that even the hottest stocks can experience significant volatility and downturns. Instead of chasing hot stocks, consider building a diversified portfolio of high-quality companies across different sectors and industries. This can help you minimize your risk and maximize your returns over the long term. Mistake 3. Overtrading. Overtrading is another common mistake that novice investors make, particularly those who are new to the stock market. It can be tempting to constantly buy and sell stocks in an attempt to make quick profits, but this strategy can often lead to high transaction costs and missed opportunities. To avoid this mistake, focus on building a long-term investment strategy that aligns with your financial goals and risk tolerance. Instead of trying to time the market or make short-term trades, consider holding onto your investments for the long haul and reinvesting your dividends to compound your returns over time. If you do decide to make trades, make sure to do so thoughtfully and with a clear strategy in mind. Avoid making impulsive decisions based on emotions or short-term market fluctuations. Mistake 4. Ignoring diversification. Diversification is a key principle of investing, but many novice investors make the mistake of putting all their eggs in one basket. This can leave them vulnerable to significant losses if a particular stock or sector experiences a downturn. To avoid this mistake, make sure to diversify your portfolio across different asset classes, sectors, and geographies. This means investing in a mix of stocks, bonds, and other securities, as well as spreading your investments across different industries and countries. By diversifying your portfolio, you can minimize your risk and potentially increase your returns over the long term. Consider working with a financial advisor or using a robo-advisor to help you build a diversified portfolio that aligns with your goals and risk tolerance. Mistake 5. Letting emotions drive your decisions. Finally, one of the biggest mistakes that novice investors make is letting their emotions drive their investment decisions. It's easy to get caught up in the excitement of a rising market or the fear of a market downturn, but making decisions based on emotions can often lead to poor outcomes. To avoid this mistake, try to take a rational and objective approach to your investments. Stick to your long-term investment strategy, even in the face of short-term market fluctuations or external events. Consider using tools like stop-loss orders or limit orders to help manage your risk and remove some of the emotion from your investment decisions. And if you find yourself getting too caught up in the day-to-day movements of the market, consider taking a step back and focusing on your long-term goals. Bonus tip: keep an eye on fees. One often overlooked aspect of investing in stocks is the fees associated with trading and holding investments. These fees can add up over time and eat into your returns, particularly if you're making frequent trades or investing in high-cost mutual funds. To avoid this mistake, make sure to keep an eye on the fees associated with your investments. Look for low-cost index funds or exchange-traded funds, ETFs, that provide broad exposure to the market without high management fees. Consider using a discount brokerage or online trading platform that offers low commission fees for stock trades. And be mindful of any account maintenance fees or other charges that may be eating into your returns. Let's recap the top 5 mistakes to avoid when investing in stocks. Number 1. Failing to do your research. Take the time to thoroughly research any potential investment before buying. Number 2. Chasing hot stocks. Focus on investing in companies with strong fundamentals and long-term growth potential, rather than chasing short-term gains. Number 3. Overtrading. Build a long-term investment strategy and avoid making impulsive trades based on short-term market fluctuations. Number 4. Ignoring diversification. Diversify your portfolio across different asset classes, sectors, and geographies to minimize risk and potentially increase returns. Number 5. Letting emotions drive your decisions. Take a rational and objective approach to your investments and stick to your long-term strategy even in the face of short-term market fluctuations. And don't forget the bonus tip. Keep an eye on fees to maximize your returns over the long term. What should I do if one of my stocks experiences a significant decline in value? A. If one of your stocks experiences a significant decline in value, it's important to avoid making impulsive decisions based on emotion. Take a step back and reassess the fundamentals of the company and the broader market conditions. If the decline is due to a short-term event or market fluctuation, it may be wise to hold onto the stock and ride out the volatility. However, if the decline is due to a fundamental change in the company's business or financial situation, it may be time to reconsider your investment. Always make sure to do your due diligence and consult with a financial advisor before making any significant changes to your portfolio. Investing in the stock market involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, be sure to consult with a qualified financial professional or advisor. The creators of this video are not responsible for any investment decisions or outcomes that may result from following the advice provided. Additionally, the mention of any specific stocks, funds, or investment products in this video is for illustrative purposes only and does not constitute an endorsement or recommendation to buy or sell these securities. Always do your own research and due diligence before making any investment decisions. Ready to start investing in the stock market like a pro? Take the tips and strategies from this video and start putting them into action today. Whether you're a beginner or an experienced investor, avoiding these common mistakes can help you maximize your returns and reach your long-term financial goals. And if you found this video helpful, be sure to like and share it with your friends and fellow investors. Don't forget to subscribe to our channel for more investing tips and strategies delivered straight to your inbox.